All right, so let's begin the show with our discussion on gold run-up and the kind of strategy that you need to have in your portfolio just in case you have extended your gains in gold. It's the time to rebalance and what's going to be the trajectory as far as gold prices are concerned, when we relate them with dollar index and the inflation concern over here. Let's get on board. Chandrashekhar, commodity expert, and elaborate on this topic. Hi, good evening, sir, and welcome to the Money Show. All right. A lot of triggers for gold to go up, but what is your assessment? If you talk about the US economy, the kind of data that's coming up, it's very robust, and the chances of the rate cuts happening in the second half of this year also have started looking bleak now. Talking about inflation, we are to see the numbers coming up ahead, but then the signs of a rate cut gave a good boost to gold prices. And talk about dollar index, usually we don't see dollar index and gold going up together. This is the kind of scenario where the robust data is obviously giving a lot of power, energy to the dollar index, and so we're seeing the ratio also going up together in gold as well as dollar index. Now, even if dollar index is likely to come down for the experts, and obviously you will also elaborate more on that, what are the signs of gold stopping its run? Do you see that happening, or do you see it's time for gold to shine and in fact beyond equities as well in terms of returns?
Before I respond to this question, I was actually wondering, and I feel a little amused and it needs research. When was it last time that both Sensex and gold prices were kind of moving in tandem, and gold is above 70,000 and Sensex is 75,000? I can't recall a time when they were closer to each other or this close to each other. I think that is probably a great subject for research. Okay. Having said this, let me say that I strongly believe that gold has overshot to the upside. There is a combination of factors which has driven gold prices up. Well, of course, we know geopolitical uncertainties, which has enhanced the safe haven appeal. You have the expectation of US Fed interest rate cut, continued central bank buying, ETF inflows have recently risen. More importantly, there's a massive inflow of speculative capital. On the bourses, huge speculative long positions have been built. All this together, in my view, is exerting an exaggerated impact on prices. And therefore, I believe gold at closer to $2,300 a troy ounce is completely, definitely overshot to the upside. Therefore, I suspect some kind of an irrational exuberance is building, or let me not say irrational, I would say less rational exuberance is building in the gold price trajectory. I'm saying this because look at the current economic situation, political situation, gold market conditions, all this taken together, in my view, do not justify this kind of a price. And therefore, I think we need to be cautious. Investors need to be cautious. Yes, we have to be optimistic about gold prices in the second half of the year, no doubt at all. But I think that should be tempered with extreme caution, at least in the short term.
All right, so the prices are not justified according to you, and there has to be a cautious strategy that investors need to adopt. I also have with me Kunal Shah, Head Research, Nirmal Bang Securities. Kunal, hi, good evening and welcome to the Money Show. So we heard Mr. Chandrashekhar analysis. What is your view in terms of prices, and do you also see the run being very momentary as far as gold prices and also, in fact, silver concerned?
Yeah, so I partly agree with what Chandrasekhar ji has said. Right now, it seems that there's no point in aggressively buying gold right now at these levels. There is a possibility of some correction due to any reason which may come. So maybe out of US inflation numbers, or there can be any trigger. But recently, the surge in gold prices is a combination of many things. And one of the major things I would like to talk about is basically what is happening is that since the geopolitical landscape of the global economy is worsening, just think from the point of China or Russia, who have a huge dollar foreign exchange reserve, and let us say if the geopolitical conflict is getting escalated, where they are going to sell those reserves. They may get a sanction, they may get their dollar reserves freeze by the US. So that's why these people are buying gold left, right, center. All the major central banks, especially the Chinese, the Russian, all these guys are buying. They are buying gold aggressively. They are diversifying their entire gold reserves, foreign exchange reserves, slowly and gradually towards asset called gold. And the point of view is, if the geopolitical scenario worsens, gold is going to react like the way it reacted right now. Because if you think from the point of view of central bankers, so if I am a PBOC and if I have to diversify 20% of my foreign exchange reserve, I am not going to put that money in US Treasury. I'm not going to put that money in Japan's Treasury. I'm not going to put that money in Europe's Treasury. Then where I'm going to put my money? So please understand the rally of this time, the gold's rally, is not do more than logic. This is not just a normal traditional economic theory that the stronger dollar, lower gold prices working. Okay, dollar strong, gold strong, it's working because central banks are buying left, right, center. So this is one thing. Second thing is the rate narrative. So last year we saw gold making a high of $2,100 with the interest rate at 5.5%. This time the dollar index, this time we are going to see at least 2 to 3 rate cuts. So the entire path of the monetary policy is changing. So gold should have responded. And most of the people, they argue that since there is going to be rate cut in the second half, why gold rose in first half? So what do you think? Gold will wait till the time the central bank will cut the rates? No, we've seen across all commodities. So the market is expecting a sharp U-turn in the monetary policy of the European Central Bank, Federal Reserve, UK Central Bank. All of the Western central banks are going to cut the rates, irrespective of where the inflation is, because they cannot service their debt if the yields keep rising. So the narrative of rate cut is the second reason, apart from what central banks have been doing, and that makes a very strong case that whenever there is a correction of $100, $120 in gold, maybe perhaps around 2,300 or 2,280, these are the time you again buy gold. Gold is going to go
Right.
up. It is a strategic investment, and
Right.
irrespective of price level, you have to be in gold.
Exactly. Yeah, you really need to diversify, because when we talk about having a financial portfolio, you cannot not have gold in your portfolio, but then you really need to figure out as to what kind of exposure and the ratio that you want to give to this asset class. Now, Chandrashekhar sir, now if at all you are heavily into gold in your portfolio, and I would also like an analysis from you on silver prices. But before that, if you are heavily invested in gold and seeing huge profits in gold, as far as your portfolio is concerned, is it the time to rebalance? Is the time to maybe, just shift that money to some other category, maybe an equity or a debt? Or you think that if one is a long-term investor, you can stay put in it and maybe just look at silver if you don't have the portfolio, because there the run-up is much more promising than gold. What would you?
Before I answer that, again, two things. One is a disclaimer. I am not a trader. I don't hold any trading position anywhere in any commodity. I'm actually a student to the market, and I must say with a little bit of pride, I'm a diligent student. Okay, that's number one. Number two, look at the current gold prices before we talk of the future trajectory. My sense there is at least a $200 risk premium built into the current price. Imagine a scenario where tomorrow, because of US intervention, there's a ceasefire announced between Israel and whatever Hamas or in the Gaza region. There will be a very sharp correction in gold prices, and therefore when prices rise, it's the nature of the market. When there are signals that these geopolitical tensions may abate, the less committed bulls in the market will be very quick to exit. Okay, and therefore that's we need to understand. At the same time, if the war were to escalate, obviously it will fuel further price rise of gold. That safe haven status will enhance. All that is understood. The next point I want to make is look at the physical demand. Physical demand is being destroyed. In price sensitive markets like India, people are moving away from gold, and scrap sales, on the other hand, are increasing. Central bank buying is the only thing that, in my view, is supporting supporting the market. But how long that will continue, how far that will continue, is I don't know. It's subject to different viewpoints. Now, coming to your question, that where do I see prices going and where will I put the money? I don't have the money. I'm not going to put any money. In the short run, I expect, and I will not be surprised if gold starts to correct from the current levels of closer to $2,300 by at least $100, $125, because there will be profit taking. There will be people will liquidate their position, book their profit, and probably then reinvest in the market again. But second half of the year, I am clear in my mind, the rate cut is not going to be anytime before June. And once the rate cut cycle starts, that is a time dollar will weaken and gold will again get one more boost. That will be a more solid boost in my view, and that can potentially propel gold higher. But that will be in the second half of the year. But again, as prices keep going up, physical demand destruction will become increasingly inevitable. That's something all of us have to remember. And the market cannot defy the fundamentals for a long time. Okay. There is a lot I want to say.
Before I go to Kunal for a strategy, as far as a medium term or a short term outlook is concerned, Chandrashekhar sir, one last question to you on this. What could actually go wrong in terms of Indian economy and the Indian state, where gold prices can just reach up to 1 lakh?
That's it. I actually no. I'll tell you something. With due respect to you and to everybody else, this is the kind of leading question that leads to a speculative fervor. You're showing a carrot people at a distance. My sense, very strongly, gold is not going anywhere near 1 lakh rupees. Okay, anytime soon. This is the first proposition I want to make, because there are limits. Number one. Number two, what if the rupee were to devalue and depreciate? Today it is 83. What if it becomes 93 6 months from now, 1 year from now? It's not going to happen. I'm talking about a hypothetical situation that can drive domestic gold prices higher. I don't see international prices going far higher, which will have an impact on Indian rupee prices that would take gold to 1 lakh rupees per 10 grams. I don't see that situation at all. Till the end of the year, if I can say that I see prices actually ranged between 68,000 and 72,000, or maybe at best 73,000, provided RBI continues to support the rupee and does not allow it to depreciate.
All right, so that's a word coming in as far as gold's 1 lakh prices are concerned. But then a quick strategy, medium term and short term outlook from Kunal. Kunal?
Yeah, so in near term, Chandrashekhar ji, gold prices risen to an extent that another $25-30 of upside will not be would be something which people should sell. So I think around 70,500, 72,600, these are the kind of levels where I think one should sell gold, and they can see, in some time perhaps around 70,000 or 69,500, these kind of levels, and you should not keep a stop loss of around 73,800, something like that. But near term, the upside is not limited. We are going to see some correction going forward.
All right, I think that will be all. Thank you so much, both of you, for being on the show and helping our viewers with their strategy, on gold, and as far as the diversification part in their portfolio is concerned across commodities. Thank you.